If you are wondering what the theoretical basis for the discounted cash flow DCF framework is, this video will help you understand why this framework can help us connect with the economic and business realities of our firms. And yes, it will involve some maths. An equity interest in a firm entitles us to a stream of future dividends for the rest of the life of the firm. If, for example, the firm is liquidated or taken over at the end of its life, this would include a final dividend representing the remaining assets after all liabilities of the firm have been settled, or alternatively, a payment to the equity investors from the party taking over the firm. That is what an equity interest entitles you to, nothing more and nothing less. The equity value of a firm is the present value of expected future dividends. Pythagoras, about 2,500 years ago, thought that all things were numbers. He thought the underlying, unseen reality could be expressed in the relationships of numbers. Accounting is all about numbers. We'll be expressing several key relationships between accounting numbers by way of mathematical expressions. They can be expressed in words, but it is possible to express these relationships more briefly and precisely in mathematical terms. As we said, the equity value of a firm is the present value of expected future dividends. This can be expressed as the discounted dividend model, where div small t equals the expected future dividends each year. The subscript t refers to the year. For example, div 1 refers to the dividend at the end of year 1, div 2, year 2, and so on. Greek symbol rho e is the cost of equity capital. If the cost of equity capital is 10%, it is calculated as 1 plus 0.10, which is 1.10. And the ... refers to eternity. The dividend discount model is the theoretical basis for us to value equity in a firm. We forecast dividends to eternity that we expect to receive and discount them to the present by applying a suitable discount rate. The only problem with this is that it is impossible to forecast a firm's dividends. Dividends are not the source of value for equity investors, rather they are simply a transfer of value between a firm and its equity investors. For example, a firm may decide to increase its dividend payout ratio, that is the proportion of earnings distributed to its ordinary shareholders, from say 10% to 90% of earnings. Assuming no change to earnings, this would result in dividends increasing by 9 times. Does that now mean the equity in the firm is worth 9 times what it was worth prior to the change in dividend policy? That does not seem to make much sense. It is difficult to forecast a firm's future dividend policy to eternity, or to the end of a firm's life, because it is based on the discretion of a firm's management and board of directors, who may consider a range of factors in making their decisions. To value the equity of a firm in practice, we will need to move in behind the dividends a firm pays its equity investors. We will need to engage with the economic and business realities of a firm that are driving the future creation of value by the firm for its equity investors. One way to do this is to focus on the cash flows a firm generates from its operating activities. Dividends and cash flows are related. This relationship can be expressed like this. Dividends D equals operating cash flow C minus capital outlays I plus net cash flow from debt owners F. Remember that our idea of dividends is net dividends, meaning it is the net payments to equity investors in a firm. It would include dividends paid to equity investors, new issue of shares, share buybacks, indeed any transaction between a firm and its equity investors. Operating cash flow, which is the cash generated by a firm's operating activities, essentially cash received from selling goods and services, less the cash expenses incurred to generate these cash inflows from sales, for example, salaries, advertising and rent. And capital outlays are the cash invested into the operating assets of a firm that generate products or services for sale. For example, new factories, new retirement villages, additional inventory, or a new warehouse. Less the cash generated by selling operating assets, for example, selling some surplus land or an old factory. Operating cash flow C, less capital outlays I, is known as free cash flow. In other words, FCF, free cash flow, equals C minus I. We use the letter I to represent capital outlays because it is the net cash investment into a firm's operating assets. If a firm had no debt or borrowings, dividends, that is the net cash flow between a firm and its equity investors, would simply equal a firm's free cash flow, that is, its operating cash flow less capital outlays. However, usually a firm does have some borrowings. Net cash flow to debt owners would include interest payments to and from a firm, as well as new issues of debt and repayment of debt by a firm. In this way, dividends will depend on a firm's free cash flow and on the level of net cash flow from debt owners. This is the source of dividends. Our relationship between dividends and cash flows can be expressed like this. Dividends D equals free cash flow, FCF, plus net cash flow from debt owners, F. Rearranging this expression, free cash flow, FCF, equals dividends D minus net cash flow from debt owners, F. So there is a relationship between a firm's dividends, its net cash payments to its equity investors, and its free cash flow from its operating activities. For this reason, it is possible to focus on cash flows rather than dividends when valuing equity in a firm. A valuation of the equity in a firm based on discounting future free cash flows, DCF, of a firm draws on the same theoretical base as a valuation based on discounting future dividends, namely the value of equity is the present value of expected future dividends. By focusing on free cash flows rather than dividends, we no longer need to predict the dividend policy of a firm. We can use the discounted cash flow approach to value a firm, or the firm's operations, or the enterprise. We can then value the equity by deducting the value of debt. We can recast the dividend discount model to focus on calculating the present value of free cash flow. We replace dividends with free cash flow each year, C minus I. If we forecast free cash flow instead of dividends, we are ignoring the effect of debt, or in other words, we are valuing a firm's operations independently of how it is financed with debt or equity. So we use WACC, the cost of capital for a firm or for its operations, as the discount rate rather than the cost of equity capital. We do this because discounting a firm's free cash flow gives us the value of a firm's operations or its enterprise value. We then deduct the value of debt to give us the value of equity. For further information on the theoretical basis for the DCF framework, go back to Chapter 3, Section 3.4 in the study guide, and review the many ways to assess value weekly questions. Also answer, write and rate questions on many ways to assess value in Peerwise.